Welcome back to the Deep Dive. It is great to have you with us.
Great to be here.
Today, we are tackling a subject that, it just feels like the absolute elephant in the room for the modern economy. We're calling it the economic divergence.
It's a massive topic, and frankly, it's one that challenges a lot of the assumptions we all grew up with.
It really does. It's this undeniable split we're seeing between the traditional path, the four-year degree, the corporate ladder.
Safety of the office, right?
Exactly. And the sort of rising financial power of skilled trades and service businesses. For the longest time, the advice was just so simple. Go to college, get the paper, get the safety.
Right, that was the golden rule. The idea that you could decouple your credentials from financial stability was, well, it was unthinkable.
And now?
Well, now we have this stack of research data from the Bureau of Labor Statistics for 2024, 2025, some really fascinating financial modeling for startups, ROI analysis. And when you put it all together, that old story isn't just cracking, it's shattering.
And that's exactly what we want to get into today. The core question we're asking is pretty blunt. Why are some incredibly expensive degrees producing such, well, weak financial outcomes compared to, say, starting a cleaning business?
It's a valid question, and one that really requires us to just look at the numbers, without the emotion.
Looking at the overview you sent, the contrast is just stark. You have degrees costing upwards of $200,000
Or more.
or more, with a payoff that might take decades,
Yeah.
versus a service business you can launch for under 15 grand that starts making money, next week?
It's startling when you see it side by side. And look, just to be clear about our mission for this deep dive,
Yeah.
we're not here to bash college.
You're right. No follow your passion fluff
Yeah,
today.
exactly.
Yeah.
We just want to strip away the narrative and look at the math, unpack the financial facts, costs, debt, ROI, recession resistance. We need to treat these paths like investments.
Yeah.
Because in 2026, that's what they are.
Okay, so if we're treating this like an investment, we have to start with a buy-in price. Let's talk price tags, because the numbers in these reports are, well, they're eye-watering.
They really are. So if we look at the sticker price for the 2025-26 academic year for a private nonprofit four-year college, tuition alone averages about $45,000 annually.
Just tuition, just to sit in the seat.
Correct. That gets you in the door. But of course, you have to exist, you have to eat, sleep.
Buy the textbooks.
Right. So when you add room and board, all the fees, the total budget averages over $65,000 a year.
Okay, so let me do some quick napkin math here. $65K a year times 4 years. That's $260,000, a $250,000 before you've earned a single dime.
And that's assuming you finish in 4 years.
Right.
Now, contrast that massive investment with, bootstrapping a service business.
Bootstrapping meaning you fund it yourself, start small, maybe use savings.
Exactly.
Yeah.
You look at a residential cleaning business, the launch cost, supplies, insurance, licensing is typically between $2,000 and $6,000.
$2 to $6 grand.
Even something that needs a vehicle, like junk removal, you're looking at maybe $2,000 up to $25,000 if you buy a new truck.
That is just a massive delta. You're talking about the price of a used Honda versus the price of a small house.
It's a completely different barrier to entry.
But it's not just the money out, right?
Mm.
The other thing that stood out to me was the timeline, the time in.
This is the idea of opportunity cost, and it is so crucial here. On the academic path, you have a 4 to 6 year period of just study. You're not earning a professional salary. You are paying to be there.
You're in the red.
Deep in the red. Now, the service path, your time to revenue is, 0 to 3 months?
Right. You buy the mop, you get insurance, you clean a house, you get paid.
Precisely.
Mm-hmm.
And the research actually quantifies this. A student doesn't just pay that $260 grand in tuition. They also lose about $170,000 in potential wages they could have earned during those 4 years.
Oh, I see. So the true cost isn't just the university's bill, it's the bill plus the money you didn't make.
Exactly. The total economic hit is closer to $500,000. Meanwhile, the service entrepreneur is out there accumulating what we call market hours. The student is digging a hole while the entrepreneur is pouring a foundation.
That brings us to the D word, debt. Because you're usually using a shovel made of loans to dig that hole.
And this is where the type of debt is so important. The average federal student loan debt is around $39,000. You add in private loans, it's about $42,000.
Which, it sounds manageable for a high earner, maybe?
It sounds manageable, but that's an average. If you get a master's, that debt spikes to almost $69,000. Medical school, you're looking at $200,000? Easy.
And The kicker with student debt, and I feel like we always gloss over this, is that it sticks to you like glue.
That is the crucial distinction. It's generally non-dischargeable in bankruptcy. It's based on theoretical future earnings. You're borrowing against money you hope you'll make. There's no collateral.
Right.
Now, compare that to a small business loan. Those are often asset-backed.
Meaning, if I take out a loan for a junk removal truck and the business fails...
You sell the truck, you have a physical asset you can liquidate to mitigate the loss. If your degree doesn't get you a job, you can't exactly return it for a refund.
You can't sell your diploma on eBay.
Not for anything close to what you paid.
Now, I do want to push back a little here. I mean, not every service business is just a guy with a bucket, right? Some must be pretty expensive to start.
That's an incredibly important nuance. We shouldn't pretend all trades are low cost. Let's look at what the research calls a heavy service model.
Okay.
Imagine a multi-crew handyman service that uses its own app for bookings. You're not a solo operator. You're building a real system.
A real company with employees, infrastructure.
And the research shows this can require significant capital expenditure, or CapEx. We're talking between $145,000 and $212,000 to start.
Wow. Okay, so that's getting up there in your college costs. What on earth costs $200,000 for a handyman business?
It's the infrastructure. Fleet vehicles, that's $70,000 right there. Specialized tools, another $22,000. And if you're developing a custom app, that could be another $45,000.
So you're taking on a big risk there.
You are. The time to cash flow break even for that model is about 32 months. So you're burning cash for over 2 years.
A long runway.
But
Yeah.
compare that to the degree timeline, it's still shorter.
It is still shorter than a 4-year degree.
You're breaking even and building equity in a sellable asset 2 years before the student even tosses their cap in the air. You own a business system, not just a qualification.
That's a great point. You're building equity versus just building a resume. Which brings us to the payoff. We all grew up hearing about the college premium, that a degree is a golden ticket. Is that still true?
It's true on average, but the average hides so much pain. The data on underemployment is, frankly, alarming. 52% of college graduates are underemployed when they first enter the job market.
Wait, define that. What does underemployed mean exactly?
It means they're working jobs that don't actually require the degree they just paid $250,000 for.
So baristas with a history degree.
Baristas, retail sales, gig work, yeah. And the scary part is how persistent it is. You'd think it's for a year or two, right? But 10 years later, 45% of those graduates are still underemployed.
Wow. Nearly half just get stuck there.
It's called the scarring effect. If you start in a low-wage job, you miss out on skill development, you never really catch up. Underemployed grads earn only about 25% more than high school grads.
So the premium is basically gone once you factor in the debt.
It's effectively erased.
But surely this depends on what you study, right? I'm guessing the engineers are the ones pouring coffee.
You guessed correctly. And this is so vital. We have to stop saying degree. Like, it's one thing. The ROI variance is massive. If you study engineering, computer science, nursing, the lifetime ROI is huge. Over $500,000, those are the winners.
Okay, so who are the losers in this data?
The data points to arts, humanities, psychology. These are often low or even negative ROI fields.
Negative ROI.
Negative. One study found that 31% of students are in programs with negative ROI. It means the cost of the education is more than the financial benefit over a lifetime. You would have literally been better off not going.
That's just heartbreaking. You pay to be poorer. So what's the ROI on the trade side?
It's surprisingly strong.
Yeah.
A technical trade certificate often has a higher ROI than the median bachelor's degree. And for business owners, profit margins for something like cleaning can be 10 to 25%.
Let's talk actual income. What are starting salaries looking like?
For humanities and arts grads, the median start is around $45,000. Now, compare that to a skilled electrician or plumber. They're starting between $55,000 and $65,000.
And the solo business owner?
A solo cleaning owner can net $30,000 to $60,000 in year one. It's comparable to the humanities grad, but remember,
Zero student debt. Every dollar is theirs.
exactly.
Okay, so what about mid-career? 10 years out, does the degree finally win?
This is where that divergence really gets interesting. The humanities grad 10 years in averages about $69,000 to $73,000. A slow, steady climb.
Okay.
But the entrepreneur who is scaled, who built that multi-crew agency we talked about, by year 5 to 10, their median earnings can be over $136,000.
Wow. They double the grad's income.
Easily.
Yeah.
And master tradesperson, a contractor who owns their own firm, they frequently clear 100 grand. The ceiling is actually higher.
But we have to talk about risk. I mean, the world is changing so fast. Let's start with the robot in the room, AI.
This is critical for the 2025-2026 outlook. The data on AI exposure is just. It's a completely different story for these two paths. Office and admin roles bookkeeping, data entry face, a 65 to 96% task replacement risk.
96%, that's the whole job.
It is. In 2025 alone, 76,000 jobs were cut specifically because of AI. But you look at the trades, electricians, plumbers, HVAC installers,
What's their risk?
effectively 0%.
Because a robot can't climb into a crawl space and figure out weird wiring.
Precisely. AI is terrible at navigating a cluttered basement to fix a leaky pipe. It can't replicate physical dexterity in unpredictable environments. The physical world is becoming a massive strategic moat.
Okay, so the trades save your job from the bots, but what about your body? We always hear trades are hard on your health.
And that's a real argument. It's physically demanding. There's a risk of acute injury, backs, knees, sure. But the research highlights a different risk on the other side. Sedentary behavior, the sitting disease.
Well, yeah, sitting is the new smoking, right? I
Yeah.
heard that.
The data supports it. Office workers who sit all day have significantly higher risks of all-cause mortality. One study showed a 16% higher all-cause death risk for those mostly sitting.
So you're trading back pain for heart disease risk.
In a way, yeah. Neither path is risk-free. You just get to pick your poison.
Let's pivot to economic resilience. We're always hearing about the next recession. Which path holds up better when things go south?
This is the recession-resistant argument.
What?
When people need to cut spending, they cut discretionary things.
Right, they stop going out to eat.
They cancel the fancy software, the marketing consultant, but
Toilet still breaks.
the toilet still breaks. They cannot stop fixing a burst pipe. They need their trash removed. They need electricity. These are essential services.
So the boring businesses are the safe ones.
Boring is profitable. Laundromats have a 95% survival rate over 5 years. Vending machine routes, 80 to 90%. Cleaning is evergreen demand.
And compared to, say, a flashy digital startup,
Oh, it's a bloodbath by comparison. A 50% failure rate in 5 years for many online businesses. The barrier to entry is so low, competition is brutal. The difficulty of the trades is the protection.
so we've covered a lot: costs, debt, ROI, AI risk. If you're trying to synthesize this for someone standing at this crossroads, what's the decision framework?
I think we have to agree the one-size-fits-all college mandate is officially obsolete. It just doesn't work anymore. The decision really comes down to what kind of worker you are.
Okay, break that down. When does college still win?
College wins if you're a specialist. If you're going into those high ROI fields, STEM, nursing, law, medicine. If the field requires a credential and it pays well, the degree is still a fantastic investment.
Right. Don't skip med school to open a laundromat.
Please don't. But the trades or a service business wins if you're what I'd call a pragmatic generalist.
A pragmatic generalist. I like that.
Yeah. If you're debt averse, if you want a direct link between your effort and your income, and crucially, if you want to be unautomatable, the physical world is your safety net.
So in the 2026 economy, value is really determined by scarcity.
It is. Knowledge work is becoming abundant and cheap because of AI. Physical work is becoming scarce and expensive because of labor shortages. Supply and demand are flipping the entire script.
It really makes you wonder about the future of status. You know, we've spent so long putting white-collar work on this pedestal.
Which leads to a provocative thought to leave with everyone. If knowledge work is getting automated and physical work is getting more scarce and more lucrative, are we witnessing the end of the white-collar prestige era? Will the next generation look at a master plumber the way we used to look at a lawyer?
That is something to chew on. The world is changing, and your career strategy probably needs to change with it. Thanks for diving in with us today.
Always a pleasure.
We'll see you on the next deep dive.